Good day, all. Ira Epstein of Linn and Associates with your metals market wrap-up, and this wrap-up is for Monday, the 30th of March, 2020, 5:20 p.m. Daylight Savings Time. We're already into the next session, so we're looking at Tuesday's trade session. Stock market in the green, but I'd be very careful. Big up days on a Monday often lead to a reversal on a Tuesday, and it's the flip-flop. When you get a big reversal on a Monday to the downside, the reversal to a Tuesday up often occurs. Keep that in the back of your mind. Gold is just not acting well. The gold market, the stock market, keep in the back of your mind this. We're at the end of a quarter. We're at the end of a month. A lot of traders book in profits, losses, whatever it is for their books, so be a bit careful with all this action. When we look at a weekly chart of just closing prices to get rid of the noise of highs and lows, the bias is up since the market's over the 18-week average of closes. When we look at a general bar chart, this is highly unusual action. It all began right through here in the early part of March, and it has gone crazy all month long. As we look at the pattern, we have a pattern of higher lows, and this high was higher than this one way back here. So I'm still in a bullish pattern of higher lows, higher highs. In order for that to change, you need to get maybe a pause right here where you get this high and that one saying, well, we don't have anything but lower highs and higher lows. We don't have that just yet. When we look at moving averages to see what the market's doing, we can see it held very well the 200-day, bounced back to the 100, came back, then the market went up. Now, what you don't want to see if you're a bull is to see the 1612 taken out right now. What that would do is it would create a pattern of lower highs, lower lows, back to the 18-day average. That's not bullish. If I'm a bull, what I want to defend in the market is not taking out 1612. When I look at Bollinger Bands, they're not in play. Now, what do I mean by not in play? The lower band's 1447, so that's almost $200 an ounce away from where you're at. And the upper band is way up here at the 1740 level. You'd have to rally $100 an ounce. They're too far away to be offering us much in the way of advice. When I look at slow stochastics, which is my momentum index, the market's overbought. Any reading in the slow stochastic that is over 70 is overbought. Now, if both numbers are going sideways over 80, that changes the momentum. That's not where we're at. So I have a market that is overbought, in an uptrend, sort of stalling right here. When I look at the June gold versus May silver gold-silver ratio, I saw that somebody wrote me on the update today on YouTube, and they were asking me a question, is this normal? Number one, 120 is a historic number, let alone 125. No, these are big-time numbers, all due to the fact that traders have been buying gold as a protection asset. Silver doesn't fit into that category. I don't care what those ads on TV say. Silver, the other metal. It's not the other metal. It's an industrial metal. There's a reason per ounce what it costs. And what it costs per ounce in the futures is $14, not $1,600, not a palladium number. Keep that in the back of your mind. On the other hand, what I look at in pattern is a lower low, right through there, and a high that took out a prior high. That's not a trend. Momentum going flat, bias down as it stayed under the 18-day average. Now, what could suddenly make this market look better is getting over the high of Friday. If you were to take out Friday's high of 1471, you could make an argument then higher lows, a higher high. You'd still have to close over the 1445 level, which is the 18-day average of closes. In the copper market, it is still very much in the bear camp. It has stayed number one under the 18-day average of closes. Number two, it still has lower highs, lower lows. Now, China is getting its factories up and going. I was reading news out of iron ore shipments out of Australia. And it's a saving grace for Australia because the factories have come back online. That possibly means we got too cheap here, under $2 a pound, but it doesn't necessarily mean the market is bottomed out yet. we're waiting to see. Right now, the bears are in control unless the market comes back and takes out 215.50, which would negate the downtrend. Wouldn't start an uptrend, by the way. In the platinum market, the fighting area is the 18-day average of closes. The pattern is still one of higher lows and higher highs. However, the bias is down because I define bias as where's the market in relation to that 18-day average of closes. It's down. Momentum has been coming up and suddenly it's starting to go sideways. To continue and get another leg to the upside, this market needs to get over 755.40 and close over the 18-day average of closes, something that it's refusing to do. In the palladium market, this has been year-long. In fact, all of last year, the strongest of the bull markets. The market is overbought in an uptrend, support on two levels to the downside, 2024 back down to the 1934.5 level, or 1933.5 actually, and sort of just hanging in here. The margin, $50,000 a contract. I don't think you're going to be trading that. Last in the dollar index, what's the battle zone number? The 18-day average of closes. Again, when the market's over that, I give it upside bias. When it's under it, downside bias. I have divergence all over this chart. Number one, I'm concerned that it's month end, quarter end. A lot of people have to square their books up, and that's where you get demand for dollars, and then it suddenly fleets on you. You've got to be careful. You do have higher lows. You have higher highs. The settlement was just over the 18-day average, so it's bullish. What negates the uptrend on this chart is taking out this low of 98.34.5. If that happens, you end up with lower highs, lower lows, and a possible challenge of 97.60. Therefore, the bulls cannot afford to let that number be taken out. That's how I'd be reading this chart. We talk here always for one intention, technical indicators, right? And with our good friends at Modern Trader Magazine, they've put together guides to technical indicators, volumes 1 and 2. Now, we've put them together as a PDF for you. We send them as a link. They cover all these different parts, and they give you great examples of what they are, how to work with them. It's not only a tutorial, it's a refresher for many of you. And it's something that is often, in my opinion, needed. If you think I don't go back, I was moving my office. You know all the books that I have here signed by so many people that have written these oscillators? Well, the reason is you want to keep that. How do you get with all this and how do you review? It's simple. Go to our website at www.iraepstein.com. On the bottom right, you'll see free offers, or you can click up here, right over in this area, you'll see an icon. If you're watching me on YouTube, they'll play from there. In the meantime, I'm Ira Epstein. You have a good day, and I'll see you all tomorrow.